Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you something about finance so you can put money in the bank later on. So we're going to keep talking about market efficiency. It's part two. Be sure to subscribe and get notifications so you can get parts 3 and 4 and the other stuff that follows. Look in the notes for links and websites. We build those after we do the videos, so maybe a few days, but we'll get in. Check out the books in our bookstore. There's some very good books at the end of this one, and they're there for you to see easily on drfranksfinanceworld.com. So when we talked about allocating money in an efficient market, it depends on the willingness to take risk. We said that before. And risk is relative to historical market returns, 10% returns, 20% standard deviation, just easy to think about. And allocation will drive the returns. Whether you put it into stocks or bonds or money markets will make a big difference. And risk can change based on the life cycle and the economy. The life cycle of the person involved and the economy out there as well. They do make a difference. This becomes more important when you do financial planning for people and that kind of stuff. So whether you believe the market is efficient or not, it will definitely drive your allocations. If you think the markets are efficient, like we said before, can't beat the averages, use risk-free investments and indexes. Let me just put this down there too. If you don't have time, that's something that you should do as well. If you don't have time to watch it, throw it into an index. Believe it or not, when I'm busy, and I do get super busy sometimes, any money I have, especially as I sell things, will actually roll over into an index so I can at least match the market as I try to do better. So markets, if the markets are inefficient, the research will be we're trying to find the misvalued ones. But I want to say this, it takes a lot of effort to do that. So you have to think twice before you decide to head down that road. I think it's worth it because I'm trying to put the odds in my favor, but anyways, you'll have to decide for yourself. So how do you know which one is true? Let's examine the evidence. So when you're talking about market efficiency and stuff here, Eugene Fama here, that's kind of the godfather of market efficiency out there. He eventually won a Nobel Prize in economics about there. He talked about what was efficient markets. And basically it says if there's a lot of people and there's good competition and the prices should already reflect the information that's out there, in an efficient market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. When we went through and talked about discounted cash flow, we're calculating intrinsic value. So in theory, if the markets are efficient, you're wasting your time doing that. So he had certain testing conditions. Not going to spend a ton of time on this either, but if you look at how today's markets are, you can see where a lot of these conditions are met. Do we all have equal access to information? Sure. You can go get all over the internet. Is it costless? It can be. It depends on what depth you want, but it's pretty much costless. I'm not twisting anybody's arm to buy the other side of my sale. This is a biggie one out here. You might want to ask this one. The sufficient volume on anything is super important. When I first started trading options many years ago, I didn't pay enough attention to this, and I found after the fact that the ones that I invested in didn't have good volume, so when I wanted to get rid of them, there wasn't anybody to sell them to. Open and free markets, which you have, and hopefully information arrives randomly. This is another important thing too. We can talk about whether it's statistically efficient or whether they're economically efficient. When we were at Texas Tech University, in a class we had on any given day, we could pull, it's pretty easy to do, the data to look back and see how the market done, see whether today did what you expected to or not. And we found many times that the market was not efficient. But the reality is by the time you paid the bid-ask spread and a number of other things, you couldn't make any money off that inefficiency. So for all practical purposes, the markets were efficient because they were economically efficient on a day-to-day basis. What about the experts? What do they say? This is kind of a funny slide out here because, basically the blue ones here are the ones with the sell rating and the gold ones here are the ones with the buy rating. If you look through this chart, you'll see most of the time the sell rating stocks in the next year beat the buy or hold rating stocks out there. And that's the experts, right? I mean, in this area, you can see there's a period of time, there was a number of years where the market was up 20+% year after year, which was kind of rare, but that's where the analysts were winning the game. But in the end, when it started to turn around with the stock market crash in 01, 02, you can see that the ones that they said, oh, never hold that or never buy that, you would have made more money off of. So in the end, I've seen a study too that says the professionals can't get it right, and they are wrong 55% of the time. So in theory, statistically, do the opposite of what they say. Anomalies came about. French and Fama came up with the first model where it was just the returns of an index or a stock relative to returns of the market out there in the S&P or whatever. And that was the only two variables, single factor model. And then research came around and said, you know what? Whether the firm is a big firm or a large firm actually makes a difference. So the small firms tended to outperform, and that became a small firm effect. This whole incredible January effect is not as incredible as it used to be. In the end, I saw a paper on this that said, how much did you make in the incredible January effect? 1%. I don't stop to pick up a penny, and I don't stop to invest for 1% either. But I think part of that is here we all are smart, right? We hear, oh my gosh, first 5 days of January, great. So what am I going to do? I'm going to buy in December. And so they think a lot of this got pushed back into December back there, and it became part of a Christmas rally or Santa Claus rally. Firms that sell close to their price to earnings, prices close to their earnings per share, or a low price to earnings ratio, tended to do better, and I think they still do better. We'll show you a report from Zacks research out there from 2000 to 2010 that'll show that I believe that is still something to consider out there. The Monday effect versus Friday. Friday, people are happy in theory and everything's up, so that's a good day to sell. And Monday, many of the worst days in the market have been Mondays. Monday, the market is typically down, and that's the best day to buy. What's this mean about inefficient market out there? I don't know. Let's look further. So successfully investing, all of these require those anomalies and stuff you saw previously require that accounting information is useful. You have to get in earnings to get a price to earnings ratio, for instance. So if you believe any of those anomalies, you are saying the market is not efficient. Do you think accounting information is useful? Believe it or not, they really didn't start taking a look until 1968. A big paper out there by Ball and Brown came out and said, you know what? And we're looking at months relative. So you're looking at up to a year prior. This is the earnings announcement. That the firms who had good earnings out there basically continued to have good earnings for the next 6 months forward, a momentum effect. And the ones that did poorly continued down. As a matter of fact, the ones with the least good numbers, if you will, did less good or well going forward, and they did worse in this case too. So first time they ever kind of said, maybe this accounting stuff, there's something to it. 20 years later, Bernard and Thomas repeated the test, and this is now, you're just talking about days trading to it, but there's 22 trading days a month, so you're looking at about 2.5 months prior. Anyway, what's interesting is the firms that were doing well as far as the price going up kind of spiked up right before and then continued going up after the announcement of their earnings. So I wonder if there's a little bit of early information getting out there and people buying in and so forth. But regardless, the worst one here was the worst one going 60 trading days forward too. So this post-earnings announcement drift became a deal. For me personally, when I see stocks doing poorly heading up to the announcement and then I hear that the announcement is not awesome, honestly, I sell them almost every single time because this drift can go on and on and on. And I don't want to be on the downside of that. So Petrosky is one of my favorite papers, Joseph Petrosky at the University of Chicago. He examined them both, and he said whether the market's efficient or not, and then is counting useful information helpful. By the way, I did put out a video out there about Henderson State. The last school I was at, I got to completely manage that student fund and kind of bring back from the dead, and we put some things in place that are based on these market inefficiencies, and they were good enough that at least one of the years we were there, we went to a national competition for student managed funds and had the highest risk-adjusted fund return in the country. So anyway, a process at least to think about. He examined them both, and then what did he find? How did he do that? He actually said that they had different, we missed it here. There were accounting variables too. I don't see where that's here. Anyway, he ranked them by book to market. Basically, firms that so close to book value did well. He went through and looked at 9 financial ratios, very, very simple ones over 21 years, which is a pretty long sample. And if somebody was in the top half of the population for that number, they got a 1. If they're in the bottom half, they got a 0. So what we do is 4 profitability ratios, 3 leverage ratios, 2 operating efficiency, and a partridge in a pear tree. Just kidding. But anyway, these 9 ratios gave the points plus or minus. What did he find? For the firms that didn't have any of them, the ratios were positive for them. The market adjusted return, beta and all that out there, means they underperformed by 6%. The ones with only one underperformed by 10% per year. And the ones that had an 8 or 9 did very, very well, outperforming a risk-adjusted return by anywhere basically from 13 to 16%. Those are very large numbers for a sample this long. He said out there that you could have had a market-adjusted return of plus 23% by simply selling the zeros and ones short and going long or owning the ones that had an 8 or 9. So taken together, accounting data was helpful. You could extract the winners from the losers. It's more successful for small firms. Anyway, it suggests that, on a day-to-day, maybe month-to-month, year-to-year basis, the market doesn't always get it right for specific securities. So in this one, the book that I have is the little book that still meets the market. It talks about return on invested capital, and that is the one single number he really goes with. It's one I use when I screen now. I prefer stocks that have a return that's positive, of course, and a return on capital that says they are a little more efficient in managing their money. Anyway, that book is in the bookstore, as is The One Up on Wall Street by Peter Lynch. Let's see what research has to say. So over here on the first one, it says stock market efficiency in thin trading markets, the case of the Vietnam stock market. So the market has only been around since 2000. Information about the developments and number of stocks traded and trading activity focus on the question of whether the market is weak form efficient. In other words, could you only use historical information and outperform a risk-adjusted return? Important element concerns the possible bias. Sometimes with thin traded stocks, you get these big jumps, or when you have the ones that are survivors, there's a survivor bias sometimes too. But anyway, that was part of that market, so they corrected for it. When they did, the main conclusion is that the Vietnamese market is not efficient, even in the weakest form of market efficiency. The other one that was interesting looking at here was the stock market efficiency and autopsy. That sounds frightening, doesn't it? Anyway, so they look at the different things that people said. Evidence they were reviewing was well established, like the small firm. There's a closed-end effect for stocks and funds. They do closed-end funds. Value line and the loser's blessing curse, as well as the January weekend effects. They can be explained by resorting to a noise trading model, so they say, and enforcing a high degree of pricing in the market. This model can generate cycles in stock prices similar as observed. The evidence suggests that an inefficient market the market is efficient and policies designed to mitigate price changes may be appropriate. Well, if you have policies to mitigate it, how about investing in it? So, anywho, finishing up the PowerPoint on this one though, my strategy and tip is when I look at markets personally, I look at everything in the form of a probability. I want to put the odds in my favor. I don't know if you realize it, but Vegas was born and grown on a 52-48 odds house. The house wins 52% of the time, and that's a pretty doggone big place. So I like to put the probabilities in my favor if I can by looking at anomalies and research. Don't forget to send emails and comments or suggestions. Ask Dr. Frank out there, and sector allocations is next. Have a great day. We'll catch you later. Bye-bye.